everyone, and welcome to Boss Advisory. Today we're going to learn about 7 investments to resign from your job. Financial freedom refers to having enough passive income to pay daily expenses. Financial freedom can be defined as having enough money to cover everyday costs without having to work. If you've been watching the channel for a while, you already know that obtaining assets that generate enough money to support your lifestyle is necessary for us to achieve financial freedom. But what assets can offer us protection from inflation and market downturns, in addition to income flow to cover our daily expenses? Let's discuss 7 reasons to leave your job today. Number 1. Cash flowing real estate. Real estate is regarded as one of the best methods to build wealth, and for good reason. For starters, real estate values often increase over time. The median home price in the United States during the beginning of the 1990s was $97,000, according to the historical data. Today, the typical house is worth more than $342,000. In the past 30 years, the market's worth has more than tripled. Second, a person doesn't need to have the money to buy this kind of item to own it. As an illustration, suppose we purchase $200,000 for a property, put down $40,000, and then finance the remaining $160,000 over the course of 30 years at a 2.5% interest rate. Our monthly expenses totals $830 when we include our mortgage payment, interest, insurance, and taxes. This indicates that we may purchase a $200,000 asset for $40,000 or, in many circumstances, considerably less. However, let's assume that we can rent this house for $1,200 per month. This indicates that after expenses, we have a cash flow of $370 per month or $4,440 per year. Real estate has the wonderful benefit of having your asset paid for by someone else, which enables you to increase your equity in your home. Year after year, the value of your house rises, and each month, you have positive cash flow. Not to mention the financial methods one may employ to increase their wealth through real estate. In order to finance the purchase of more properties, many investors exploited the appreciation and value of their existing properties. For illustration, suppose the value of your $200,000 property increased, bringing its current value to $250,000. You make the decision to refinance the home and remove the $50,000 in cash. You can then use those $50,000 to purchase a second $200,000 property. This indicates that you effectively doubled your cash flow by using your initial $40,000 investment to buy $450,000 worth of rising real estate. Since you now own 2 homes that provide money each month, not to mention the tax advantages of real estate ownership. Number 2. Dividend Stocks. Owning stocks in highly successful businesses that distribute dividends to their shareholders is one of the simplest methods to start generating passive cash flow. The dividend yield varies from one corporation to the next. Apple, for instance, has a dividend yield of 0.57%, while ExxonMobil's dividend yield is 5.3%. A dividend yield simply indicates what portion of the stock's value is distributed as a dividend. For example, a $100 stock with a 3% dividend yield means that you will receive $3 a year per share. Dividend yields today only make up a small part of the stock purchase decision. We must make investments in the stable businesses with a strong track record and future. For instance, AT&T has a dividend yield of 8.3%, which is significantly higher than the market average. But the stock price has fallen by almost 33% over the past 5 years. Our long-term goal is to incorporate dividends into our reliable cash flow, unless you have a significant investment budget. Let's imagine, for illustration, that your investment portfolio has a 3% average dividend yield. Consequently, we need $4,000 portfolio in order to earn $1,000 every month in dividend. Because of this, dividend investing is typically a long-term strategy. Many investors increase their portfolios to the point where their cash flow is large by taking advantage of compound interest and dividend reinvestment. However, this is a long-term strategy. It significantly improves your cash flow. Consider that this kind of income is far more passive and is taxed less heavily than regular income. Normally, shareholders of publicly traded companies have little say over how much of the company's profit are distributed to them. The following asset might be appealing to you if you desire more control over how cash flow is allocated. Number 3. Cash flowing business. There are a lot of extremely successful companies out there that are not listed on the New York Stock Exchange. These might be offline establishments like a restaurant, coffee shop, franchise, or network of ATMs, or they can be online like a software or app developer. To own the company but not run it is the aim here. Everybody cannot run a business. It takes a highly specific set of abilities to run a business successfully. Yet there are many business owners out there who hire others to run their companies for them in exchange for a competitive wage or stock in the company. Now, compared to other types of investing, this type of asset has a higher level of difficulty. This may entail either founding a company from zero and working on it until it can operate its own, looking for companies in need of an investor or a partner, or purchasing an already established company or franchise. Despite the fact that this resource is more challenging, it can offer many advantages, including control over financial flow. You have control over how much of the company's profits you can keep when you own the business. Additionally, you have various tax benefits as a business owner, such as the ability to benefit from the dividend distribution tax, which is often less expensive than regular income tax. By running a company, one may spend certain company funds prior to paying taxes, as long as it helps the business. For instance, if your firm has several locations, you can purchase a good car of your choosing as a company vehicle that enables you to travel to all of your locations. Since it is a commercial vehicle, pre-tax funds may be used to purchase or lease it. Of course, the best method to find out what you can and cannot do with your pre-tax is to always see a specialist. Since we briefly discussed increasing cash flow, let's speak about defending your wealth from factors like inflation and market collapses that aim to devalue it. Number 4. Gold. As a safeguard against inflation and asset depreciation, many affluent investors, including Ray Dalio, place a lesser portion of their investment portfolios in commodities like gold. Value allocates 7.5% of its total assets in gold as an additional layer of inflation protection when markets decline. This all-weather portfolio, which includes a strategy that allows our money to grow in any economic climate, has a strategy that allows for this growth. Gold can provide value stability in a world where currencies are devaluing. As the value of a dollar declines, gold's price tends to rise, giving its owner security or a hedge against the dollar's depreciation. Number 5. Bonds. Because they don't offer the best yields, bonds today are regarded as not very good investments. There are techniques where bonds can be utilized as a layer of protection against market downturns, especially when someone is in or approaching retirement. And in certain cases, they don't even beat inflation. Warren Buffett, a renowned investor, once said that if he died before his wife, he would give his manager instructions to leave the money for her in a very specific yet straightforward portfolio. Buffett told his manager to invest 90% of the money in straightforward index funds, such as the S&P 500, and the remaining 10% in bonds. To gauge the success of this plan, Javier Estrada, a finance professor, tested this strategy using historical market data. It outperformed most expert retirement investing advice. However, Estrada added a second twist to this strategy in order to fully utilize the protection that bonds can provide in an investment portfolio. Nobody can forecast the exact moment the market would crash. We simply know that it will occur eventually. Therefore, if we are already financially independent and living off of our investments, we must have a plan in place. Estrada advises keeping a watch on the market once a person retires and starts taking money out of their investment portfolio. Take money from the stock side if the market is doing well because it is the one generating the highest profits. But withdraw your funds from the bond side if the market is struggling and losing money. This goes into great detail about how bonds typically increase in value during weak markets, giving stocks time to recover and appreciate rather than dumping them while they are down. Number 6. Cryptocurrencies. In the modern day, it is impossible to overlook the influence that cryptocurrencies have on society and their future potential. A decentralized global currency is the whole point of cryptocurrency. Because many cryptocurrencies like Bitcoin have a limited supply that will never be available, unlike traditional currencies like the dollar that can easily be manipulated by a government to generate inflation. Many people view such cryptocurrencies as digital gold. As a result, cryptocurrencies like Bitcoin or Ethereum may soon be able to serve as a hedge against inflation and, unlike at present, serve as a type of transactional currency. The main drawback to cryptocurrency is that many people purchase them in an effort to increase their wealth, which for many has resulted in significant returns. However, it also means that there is considerable volatility and little stability in the value of cryptocurrencies. However, this kind of asset may also contribute to growth in addition to serving a hedge against inflation. Number 7. Startups and growth companies. How many of you have ever had that thought? What if I had bought Amazon 20 years ago? How much would I have right now? What if I was able to join Uber or Netflix right away? The truth is that we cannot go back in time and make investments in those outstanding businesses. On the plus side, though, new businesses are founded daily. They will ultimately be fantastic. These kinds of investments carry a hefty risk in addition to the potential for a huge return. Investors in these businesses typically devote a tiny fraction of their overall portfolio to these assets and are aware that it is likely that these investments may lose all of their value. However, if they made the proper investment in the right firm, their wealth could soar and reach entirely new heights. Even though each of these is a fantastic investment, investing in one's own education is the finest choice one can make. For individuals with education, investing in real estate can be quite profitable, but for those who are not, it might be disastrous. While stock trading can be a terrific method to create long-term wealth, we risk missing out on a great chances if we lack financial literacy. Another way you can try to work on that allows you to make profitable money online right from the comfort of your own home, and as a matter of fact, you can bring it with you anywhere you go. If that interests you, make sure to click the first link down below to find out. Thank you guys so much for watching Boss Advisory, and if you haven't yet, be sure to subscribe, give this video a big thumbs up, and hit the bell to get notified on every new incredible content we make for you. Have a wonderful day and see you in the next one.